Have you ever seen a company that looks like it's on top of the world, only to suddenly crumble? Well, today, we're going deep into a story of ambition, pressure, and some, let's just say, very creative accounting. This is a story about what happens when a company decides the rules just don't apply to them. So that brings up a really big question, right? Can a company actually lie its way to success? Can you really fudge the numbers, bend the rules, and build a thriving business on a foundation of, well, lies? Let's follow the money and see what we find out. Okay, so let's meet our subject for today, a company we'll call Deluxe Home Goods. They're a fast-growing retailer, and they have huge plans. They want to expand, big time. But, big dreams, they come with an even bigger price tag, and that means they're going to need some serious cash. So where do they get that cash? They're going after a major bank loan. But here's the catch. To get that kind of money, you have to look perfect on paper. Your financials need to be sparkling. And this is right where that pressure starts to build, and where some key people start to make some really bad decisions. So how exactly did they try to create this financial illusion? Well, they did it by breaking some of the most basic, fundamental rules in accounting. Let's take a look inside their ledger and break down the 4 key principles they just completely ignored. First up is a big one, the business entity principle. Honestly, this is like accounting 101. The rule is simple. The business's money is the business's money. It has to be kept totally separate from the owner's personal finances. The company's bank account is not the owner's piggy bank. It seems pretty obvious, right? Well, apparently not to the CEO. They were regularly dipping into the company's bank account to pay for personal things like family vacations and private school for the kids. This just demolishes that wall between personal and business. And that's not just a red flag, you guys. It's a blaring siren. It makes it impossible to know what the company's real financial health even is. Okay, next rule they broke, the revenue recognition principle. This one's critical. It means you can only count money as revenue when you've actually earned it. That means the product has been delivered or the service is done. You can't just count the money because you hope to make a sale. And this is exactly where Deluxe Home Goods got creative. To make their sales numbers look amazing for the bank, the CEO pressured the staff to record revenue for a bunch of products that were just shipped to a warehouse. They weren't actually sold to any customers. It's a classic move, literally creating sales out of thin air. Principle number 3 they ignored is the dual aspect principle. Think of this as the law of financial balance. Every single transaction has 2 sides, and they have to be equal. So if you buy something, an asset, you either had to spend cash or you took on debt, like a loan. It's the system's built-in fact checker. And this is where the lie gets even deeper. The company bought new machinery. They recorded the cash they spent, but they conveniently forgot to record the massive bank loan they took out to buy it. So on paper, they've got this great new asset, while the debt used to get it is completely hidden from view. And finally, we have the money measurement principle. This one's actually pretty simple. If you can't put a price tag on it, it doesn't go in the financial statements. So a brilliant new brand slogan? Nope. An amazing company culture with sky-high morale? Incredibly valuable for sure, but you can't measure it in dollars, so it doesn't go on the balance sheet. Now, here's where it gets interesting. This is the one rule they didn't actually break. Their star lead designer quit, which is a huge blow to the company's future, no question. But because you can't assign a specific monetary value to that loss, it's correctly kept off the books. It's a really good reminder that even perfectly accurate financial statements don't always tell you the whole story. So, we've looked at each broken rule one by one, but the real damage, it comes from how they all add up. These weren't just small, isolated mistakes. They were a series of financial dominoes, each one knocking over the next, until the entire picture of the company was a complete fabrication. And this table just lays it all out there. The fake revenue made their profits and assets look way bigger than they were. Hiding that loan made their debt seem smaller and made the company look stronger. And all that personal spending was just bleeding cash out of the company. It wasn't one lie, it was a whole web of them. Okay, so can this mess even be fixed? The short answer is yes. But it's not as simple as hitting an undo button. It takes a complete teardown and rebuild of the books, unwinding every lie, and putting things back together with honesty and integrity. Let's just take that hidden loan as an example. On the left, you see their version of the story. Cash went down, the asset went up. Looks clean, simple, and totally misleading. But on the right, you see the truth. The first two parts are the same, but now we have that crucial third piece, the new liability, that loan. Suddenly you have a real, honest picture of what actually happened.
You know, this whole story isn't just an exercise from a textbook. It's a really powerful look at why these accounting rules aren't just suggestions. They are the absolute foundation of a trustworthy business. And it shows us what the real bottom line truly is.
At the end of the day, these principles matter because they create trust. They are the common language that lets investors, banks, you, me, and everyone else understand what's really going on inside a company. Without them, that trust just vanishes, and the whole system can start to fall apart, taking people's jobs and savings right along with it. And that's really the biggest lesson here. A company can have the best product in the world, the smartest people, the most brilliant strategy, but if it doesn't have trust, all of that is built on sand. Trust is the one asset that, once it's broken, is almost impossible to get back.
Which brings us right back to where we started. The real question isn't just, can you lie your way to success? It's, what's the true cost of that lie? And that's a cost that's paid not just by the executives, but by employees who lose their jobs, by investors who lose their savings. So the next time you look at a company's numbers, remember to ask yourself, what story are they trying to hide?